Good evening. Welcome to this special edition of Market Meridian. I'm Eric. Please subscribe my channel so you will get financial information and analysis report in time. The world woke up today to a map that looks fundamentally different than it did 48 hours ago. For months, the choke point premium has dictated every tick of the WTI and Brent tickers. We watched as the Strait of Hormuz, the jugular of global energy, became a theater of high-stakes brinkmanship. But as of Friday's close and the subsequent headlines trickling in this Saturday, April 18, 2026, the jugular has begun to breathe again. Iran has declared the strait open. The war premium hasn't just leaked, it has hemorrhaged. If you are an investor, you are currently standing at a crossroads. The volatility we saw on Friday, with the S&P 500 and Nasdaq hitting fresh all-time highs while crude suffered its most violent single-session contraction in years, is not just a moment. It is a structural reset. Everything you thought you knew about the safety of gold, the strength of the greenback, and the inevitability of $100 oil is being rewritten in real time. On today's program, we are stripping away the noise. We aren't looking at the headlines you've already read. We are looking at the mechanics of what happens next week. We are analyzing the 13F implications, the institutional shift from energy to high beta growth, and the specific technical levels on the XA. For the remainder of Q2. The question isn't whether the market is moving, it's whether you are positioned to catch the rotation or be crushed by it. This is Market Meridian. Let's get to the data. Why oil is the lead domino? To understand the stock market right now, you have to stop looking at stocks and start looking at the barrel. Crude oil is the most sensitive barometer of global geopolitical stress. When the strait was contested, we were pricing in a supply shock scenario. But the announcement of the opening, combined with the nuances of the U.S. naval blockade, which President Trump has clarified is now a surgical operation rather than a blanket denial, shifts us from shortage to managed flow. Let's look at the numbers. WTI was clinging to $92 on Monday. By Friday's close, we were staring at $80.50. That is a 12% erasure of value in 5 trading days. On Market Meridian, we track the institutional pivot point. For the last 3 months, large-scale commodity hedge funds have been net long. That trade is now crowded, trapped, and looking for the exit. What happens on Monday morning? We expect the dead cat bounce. Traders who shorted the top at $90 will buy back to book profits, potentially lifting WTI back to the $83 level. But make no mistake, $85 is now a ceiling of reinforced concrete. At Market Meridian, our stance is clear: any rally toward $84.50 is a gift for the bears. To circulate through the global economy, why does this matter for your portfolio? Because lower oil is an invisible stimulus package. It lowers the input costs for every manufacturer in the S&P 500. It lowers the misery index at the gas pump for the American consumer. It is, effectively, an interest rate cut delivered by geopolitics rather than the Federal Reserve. The equity rotation, tech, transport, and the death of defensives. Now, let's pivot to the equity markets. While the headlines were screaming about Iran, the Nasdaq was quietly staging a revolution. For the past year, we've seen a barbell strategy: investors hid in energy, XLE, to hedge against war, and tech, NVDA, MSFT, to play the AI expansion. That barbell just snapped. The money is flowing out of the defense side and flooding into the growth side with unprecedented velocity. The winners, the energy-sensitives, titans. First, look at the airlines. Historically, fuel accounts for 25% to 30% of operating expenses for carriers like Delta, DAL, and United, UAL. When oil drops 10%, Their bottom-line projections don't just move, they explode. We are seeing institutional accumulation in the JETS ETF that suggests a 15 to 20% upside in the transportation sector over the next 30 days. Second, look at retail. Amazon AMZN and Walmart WMT. These are logistics companies disguised as stores. Lower diesel costs mean higher margins. But more importantly, impact of seeing gas under $3.50 again cannot be overstated. It fuels that a discretionary spender that the market has been craving, the AI alpha. We cannot talk about the Nasdaq without talking about Nvidia. As we move into next week, the narrative is shifting from inflation concerns to productivity gains. If the Fed doesn't have to worry about oil-driven inflation, they have more room to stay dovish. This is oxygen for the Magnificent Seven. We are watching the $950 level on Nvidia as a critical launchpad. If it holds, we aren't just looking at all-time highs, we are looking at a blue sky breakout. The losers, the energy Goliaths. On the flip side, we have to address the casualties. ExxonMobil XOM and Chevron CVX are no longer the safe harbors they were in March. As the spot price of crude settles into the $70s, the excess profit narrative evaporates. We are advising our viewers to look at the short energy long tech pair trade. This is the institutional play of the month. Then come to the currency war and the gold paradox. Let's move into the deep waters of the forex and metals markets. This is where the sophisticated money lives, and right now, the signals are conflicted. The US dollar to Japanese yen carry trade. The reopening of the strait is a risk-on signal. In a risk-on environment, the Japanese yen, the world's favorite funding currency, gets sold. However, we have a unique situation with the USD. Watching the 152.00 level on US dollar to Japanese yen. If we see a sustained break below 150, it tells us that the market is more worried about a softening US economy than it is excited about global peace. But for next week, our primary play is euro to US dollar. Europe is the biggest beneficiary of lower energy costs. We expect the euro to test 1.1100 as the energy tax on the Eurozone economy is lifted. The gold mystery. Then there is gold. Conventional wisdom says, peace is bad for gold. If the world isn't ending, why hold bars of yellow metal? But look at the tape. XAUEUSD is refusing to break. Why? Because the market is beginning to price in the post-war inflation. If the global economy revs up because energy is cheap, demand for everything else, copper, lithium, labor, goes up. Gold isn't acting as a war hedge anymore, it's acting as a debasement hedge. At Market Meridian, we aren't selling our gold positions. We are trading the range. We see massive support at $4,750. As long as we stay above that, the long-term structural bull market for gold remains intact. Do not be shaken out by the peace headlines. The central banks are still buying, and so should you. And now we all like to know what that smart money is hiding. One of our core missions at Market Meridian is to follow the footprints of the giants. We don't care what analysts say. We care what billionaires do. In the most recent filings and real-time flow logistics automation. Why? Because the reopening of the strait isn't just about oil, it's about the resumption of global trade lanes that have been dormant or diverted for months. Companies that facilitate just-in-time manufacturing are being swept up by institutional desks. They know that a massive backlog of goods is about to hit the West Coast and European ports. The global reopening 2.0 is the trade that no one is talking about yet. While everyone else is arguing about WTI, The smart money is buying the companies that move the world. We've identified 3 specific tickers in the logistics space that have seen a 40% increase in institutional buy orders over the last 72 hours. These are the companies that will provide the alpha while the S&P 500 grinds through its new highs. Note: subscribe to our Meridian Pro feed for the specific ticker breakdown. Before need to prepare your Monday morning playbook before market open. We have covered a lot of ground. Now, let's turn this analysis into an execution plan. If you are sitting at your terminal on Monday morning, here is your Market Meridian blueprint. Point 1. The 9:30 a.m. oil fade. Don't chase the opening bell. Wait for the initial volatility to settle. If oil gapped down over the weekend, look for a relief rally in the first hour of trade. When that rally stalls, likely around the $82.50 mark, that is your entry for a short position. Your target is $78 by Wednesday. On Monday morning, due to profit taking from Friday's highs, treat it as a gift. The macro environment, lower energy, stable yields, and de-escalating war, is the Goldilocks scenario for growth stocks. Focus on the semiconductor sector and the AI infrastructure. Play. Point 3. The currency pivot. Watch the 10-year Treasury yield. If it stays below 4.3%, the dollar is going to struggle to find buyers. Long euro to US dollar and long Australian dollar to US dollar, the risk-on currencies, are our preferred plays for the week. Point 4. The stop-loss mandate. Geopolitics is a fickle mistress. While the Strait is open today, a single naval incident or a breakdown in the Trump-Iran transaction could send oil back to $95 in an hour. Never trade without a hard stop. At Market Meridian, we recommend a 2% volatility-adjusted stop on all commodity positions. Part 7. The macro conclusion, the big picture, tone, reflective, philosophical, motivating. As we wrap up this special briefing, I want you to take a step back from the charts. The markets are often described as a voting machine in the short term and a weighing machine in the long term. Right now, the voting is overwhelmingly in favor of peace and productivity. We are seeing a rare alignment where geopolitical reality is catching up to the market's inherent desire to grow. But remember the Market Meridian mantra: price is the only truth. Headlines can lie. Politicians can post. But the tape never lies. It tells you that there is a deeper supply problem that the news isn't covering. If gold hits $5,000, it tells you the market doesn't trust the low inflation narrative. We are entering a phase of the market that rewards the active investor and punishes the passive observer. The easy money of the post-2020 era is gone. The alpha of 2026 is found in the cracks between the energy sector and the tech sector, between the USD and the euro, between the headline and the reality. Our job here is to give you the lens to see those cracks. That concludes our deep dive for this Saturday. It's going to be a historic week on Wall Street. The desks are manned, the algorithms are tuned, and the world is watching the Persian Gulf. But you have the data. You have the levels. And you have the Market Meridian perspective. If you found value in this briefing, make sure you are subscribed to our channel and have your notifications turned on. The markets don't sleep, and neither do we. We will be back with a market open update on Monday at 8 a.m. Eastern to see how our predictions are playing out in real time. For more exclusive content, including our Meridian heat map and our top 5 tickers for the peace dividend, click the link in the description or visit our website. Stay disciplined. Stay informed. And most importantly, stay profitable. I'm Eric, and this is Market Meridian.